Welcome to the Global Commerce Academy, where your journey to mastering global finance and accounting begins. We're thrilled to have you join our vibrant community of learners, professionals, and aspiring certified management accountants from all around the world. At the Global Commerce Academy, we believe that quality education should be accessible to everyone, which is why we offer 100% free CMA USA classes designed to help you achieve your career goals without any barriers. Our platform is your go-to source for comprehensive, up-to-date resources, interactive lectures, and expert guidance tailored specifically for the CMA USA exam. Whether you're just starting your accounting journey or looking to sharpen your expertise, you'll find everything you need right here. Our classes are structured to fit your schedule so you can learn at your own pace from anywhere in the world. In today's lecture, we're diving deep into one of the most fundamental and widely tested concepts in accounting and financial reporting, revenue recognition. This topic is based on the globally adopted ASC 606 standard, which sets the framework for how companies recognize revenue from contracts with customers. Understanding ASC 606 is crucial, not just for passing your CMA exams, but also for excelling in real-world finance roles, as it impacts how businesses report their financial performance. No matter where you are, whether you're studying in India, the UAE, the USA, or anywhere else, revenue recognition is a core topic that appears frequently on the CMA exam. It's essential for your success, both in the exam room and in your future career. So, stay with us till the end of this session, take notes, and get ready to master this critical concept together. Let's get started. A revenue recognition refers to the process of determining when and how much revenue to record in a company's books. Under the accrual accounting system, revenue is recognized when it is earned, not necessarily when cash is received. ASC 606 introduced a unified 5-step model to standardize revenue reporting across industries. Let's break it down. Revenue recognition is a fundamental principle in accounting, ensuring that companies report their income accurately and consistently. To help businesses navigate this process, the Financial Accounting Standards Board, or FASB, introduced a comprehensive framework known as the 5-step revenue recognition model. This model provides a clear, structured approach for determining when and how much revenue should be recognized in financial statements. Let's break down each step in detail, using practical examples to illustrate how the model works in real-world scenarios. Step 1. Identify the contract with a customer. This is the foundation of the entire process. A contract must exist between the business and its customer. This contract can be written, verbal, or even implied through customary business practices. What matters most is that the agreement creates enforceable rights and obligations for both parties. For example, a signed sales agreement, a purchase order, or even a handshake deal that's supported by a history of similar transactions can all qualify as contracts under this model. Without a valid contract, revenue cannot be recognized, so it's crucial to ensure that all the necessary elements, such as approval, payment terms, and commercial substance, are present. Step 2. Identify the performance obligations in the contract. Performance obligations are the distinct goods or services that the company has promised to deliver to the customer. In other words, what exactly is the business committing to provide? Sometimes a contract may include multiple deliverables, such as products, services, or a combination of both. It's important to break down the contract into these separate obligations, as each one may be recognized at a different time. For instance, if a company sells a smartphone bundled with a 1-year service plan, there are 2 distinct performance obligations: delivering the phone and providing ongoing service. Each obligation must be accounted for separately to ensure accurate revenue recognition. To identify performance obligations, companies should look for promises that can be clearly distinguished from one another. This might involve analyzing the contract language, consulting with legal or sales teams, and reviewing past transactions for consistency. By carefully categorizing each deliverable, businesses can avoid errors and ensure compliance with accounting standards. For example, selling a phone with a 1-year service contract means there are 2 obligations: the physical device and the ongoing support. The customer receives the phone immediately, but the service is provided over time. This distinction is critical for determining when revenue should be recognized for each part of the contract. Step 3. Determine the transaction price. The transaction price is the total amount of consideration the company expects to receive in exchange for fulfilling its performance obligations. This step goes beyond simply looking at the sticker price. Companies must consider all aspects of the deal, including fixed amounts, variable considerations like discounts, rebates, or performance bonuses, and any non-cash payments. For example, if a customer is offered a volume discount or a rebate based on future purchases, these factors must be estimated and included in the transaction price. The goal is to arrive at the most accurate estimate of what the company will ultimately collect. This is the total consideration expected, taking into account all possible adjustments. Companies must use judgment and historical data to estimate variable amounts, ensuring that the transaction price reflects the reality of the agreement. You need to include fixed and variable amounts, discounts, and bonuses. This comprehensive approach ensures that revenue is neither overstated nor understated, providing a true picture of the company's financial health. Step 4. Allocate the transaction price to the performance obligations. Once the total transaction price is determined, it must be allocated to each performance obligation identified in the contract. This allocation is typically based on the standalone selling prices of each good or service. If the standalone prices aren't directly observable, companies may need to estimate them using market data or cost-plus methods. The goal is to fairly distribute the total consideration across all deliverables, ensuring that each obligation is recognized appropriately in the financial statements. Spread the price across the obligations based on standalone selling prices. This step is essential for multi-element contracts, where different goods or services are delivered at different times. Step 5. Recognize revenue when or as the performance obligation is satisfied. Revenue is recognized either over time or at a specific point in time, depending on when control of the good or service is transferred to the customer. For some obligations, like delivering a product, revenue is recognized at the moment the customer takes possession. For others, such as providing ongoing support or services, revenue is recognized gradually as the service is performed. Revenue is recognized either over time or at a point in time, depending on when control is transferred to the customer. This ensures that financial statements accurately reflect the company's progress in fulfilling its obligations. For example, if a software company sells a license and support, revenue from the license is recognized upfront, while support is recognized monthly over the contract. This approach provides a transparent view of how and when revenue is earned, helping investors, regulators, and management make informed decisions. By following the 5-step revenue recognition model, companies can ensure compliance, improve financial reporting, and build trust with stakeholders. Imagine a company sells equipment for $5,000 with free maintenance for 1 year, which is worth $500. Revenue is allocated as follows: equipment, $4,500, and maintenance, $500. Equipment revenue is recognized immediately, while maintenance revenue is deferred and recognized over 12 months. This ensures the financials reflect economic reality, not just cash flow. Recognizing revenue before the performance obligation is satisfied, not allocating the transaction price correctly, missing contract modifications, and misjudging point in time versus overtime recognition are all common pitfalls. Here's a CMA tip. If you see a question on bundled services, think multi-step allocation. And watch out for timing traps. Remember, cash does not always mean revenue. Congratulations on making it to the end of Chapter 3. We've just wrapped up our deep dive into revenue recognition under ASC 606, a crucial part of the external financial reporting decisions section. This chapter is a major milestone in your CMA USA 2025 journey, and understanding these concepts will give you a strong foundation for both your exams and your future career in accounting or finance. In this chapter, we broke down the 5-step ASC 606 model, which guides how companies recognize revenue from contracts with customers. We walked through each step in detail, from identifying the contract to determining the transaction price, and finally recognizing revenue when performance obligations are satisfied. We also looked at practical, real-world examples to help you see how these rules apply in everyday business scenarios. Plus, we discussed some of the most common exam challenges and tricky questions you might face, so you'll know exactly what to watch out for. If you found this chapter helpful, don't forget to subscribe to the Global Commerce Academy. We're covering every single CMA USA 2025 chapter, breaking down complex topics into simple, easy-to-understand lessons. And the best part, everything is 100% free, so you can learn at your own pace anytime, anywhere. Have questions, need clarification, or want extra resources? Drop a comment below if you'd like free downloadable PDFs, practice test questions, or if you're struggling with any specific topics. Your feedback helps us create better content tailored to your needs. Remember, you're not alone on this journey. Our team is here to support you every step of the way, whether you need help understanding a tough concept or just want some study tips. We're committed to helping you pass your CMA exam on your very first attempt. Keep learning, stay motivated, and we'll see you in the next chapter.